Beneath the visible economy, the cargo ships, the skyscrapers, the global supply chains, lies a hidden financial architecture that absorbs the world's catastrophic risk. At the very top of that architecture sits Chubb Limited. Trading on the New York Stock Exchange, this property and casualty insurance giant commands a massive market capitalization of roughly $131.5 billion. Over the past 5 years, the stock has delivered a 97% return to shareholders, recently pushing toward the $365 range. That kind of sustained performance does not happen by accident, and it has attracted serious capital. Today, institutional investors hold over 83% of the company's outstanding shares. The largest single stakeholder among them is Berkshire Hathaway, led by Warren Buffett, which maintains a concentrated 8.27% position. To deploy that capital, Chubb operates an expansive global footprint, underwriting policies across 54 distinct countries and territories. Securing this level of elite financial backing requires a level of underwriting efficiency and capital discipline that routinely outperforms industry norms. The company's second quarter 2026 earnings report highlighted a significant divergence between two core performance indicators. This dual-axis chart shows the tension. Core operating earnings surged to $7.26 per share, an 18.2% increase year over year, beating estimates by 9.5%. But look at the second axis. Top-line revenue plateaued at $14.71 billion, missing the $15 billion target. This top-line miss unfolded as the broader commercial property market began showing signs of macro-level softening. Chubb generates its alpha through a model of severe underwriting discipline that prioritizes margin protection over top-line expansion. To accurately price this $131.5 billion valuation, we have to deconstruct exactly how this margin protection model works and how an impending artificial intelligence transformation is about to accelerate it. The bedrock of any insurance valuation model is the combined ratio. This metric measures incurred losses and expenses as a percentage of earned premiums. Anything under 100% means the company is turning a pure underwriting profit. This comparison chart illustrates Chubb's structural dominance. In the second quarter, Chubb's property and casualty combined ratio stood at 83.8%. The broader U.S. industry averaged 92.9%. That is a delta of nearly 900 basis points. That specific margin advantage translates directly to the bottom line, generating $1.94 billion in pure underwriting income for the quarter, an 18.8% jump year over year. This is an intentional output of executive strategy. CEO Evan Greenberg has explicitly stated the company's operating philosophy regarding soft markets, noting, "We will not underwrite knowingly to a loss." That mandate reframes the second quarter revenue miss, which included a 2.3% decline in the North America commercial segment. Management deliberately contracted exposure in large account and excess and surplus lines, where pricing no longer justified the risk, letting market share slip to preserve profitability. Management offset that calculated domestic contraction by driving 10.2% growth in overseas general insurance, while simultaneously benefiting from year-over-year drops in catastrophe losses. Chubb chooses to walk away from unprofitable market share to maintain a fortress-like combined ratio, generating structural outperformance. Once that underwriting discipline protects the downside, the resulting cash flow fuels the upside, the investment float. In the second quarter, Chubb's adjusted net investment income hit a record $1.88 billion, rising 11.4% over the previous year. The company is deploying this capital to execute strategic geographic expansions, specifically targeting high-growth emerging markets. Recently, Chubb reached an agreement to acquire the property and casualty operations of Liberty Mutual in key Asian territories. By absorbing these existing operations in Thailand and Vietnam, the deal instantly adds approximately $275 million in net premiums written to Chubb's Asian portfolio. The Thailand transaction is scheduled to close by the second quarter of 2025, with the Vietnam integration finalizing in late 2025 or early 2026. Alongside acquisitions, capital flows directly back to investors. Shareholders recently saw a 5.2% hike in the annual dividend, bringing the quarterly payout to $1.02 per share. Combining 33 consecutive years of dividend increases with strategic, cash-flowing acquisitions creates a highly defensive and continuously compounding capital allocation loop. Now, Chubb is preparing to amplify this financial loop by restructuring its internal operations, moving away from human workflows toward rapid, digitized algorithmic efficiency. In late 2025, Evan Greenberg outlined a striking operational mandate. The company plans to reduce its global workforce by as much as 20% over the next 3 to 4 years. This flowchart illustrates the mechanism of the reduction. Management is not executing mass layoffs. Instead, the 20% contraction will be achieved through natural employee turnover, as legacy roles remain unfilled. Taking the place of those unfilled roles are roughly 9 to 10 artificial intelligence pilot nodes, currently being deployed across global underwriting, claims processing, and back-office operations. As traditional administrative positions fade out, the company is pivoting its payroll, hiring almost exclusively in specialized engineering and advanced data analytics. Greenberg has noted that the cost of processing AI compute tokens is negligible compared to the massive compounding expense of maintaining legacy human capital. This dynamic shifts the firm's operational leverage. By embedding artificial intelligence into the core underwriting process, Chubb is aiming for a structural reduction in its expense ratio. This allows the company to expand its profit margins even if top-line revenue remains flat. Wall Street is now tasked with pricing this exact combination of extreme underwriting discipline and impending AI-driven margin expansion. This valuation dashboard outlines the current multiples. Chubb stock is trading at roughly 12.15 times trailing earnings and 1.76 times book value. Based on data pulled by S&P Global from 25 distinct analysts, the broader market consensus is decisively positive. The firm consensus stands at a buy rating, carrying an average price target of $366.13. Recent actions back this up, with Morgan Stanley raising its target to $360, while Argus Research points even higher toward $396. Despite trading near 52-week highs, these multiples remain historically attractive for an asset boasting this level of earnings quality and a clear roadmap for operational cost reduction. However, there are significant macro risks to calculate. The primary threat facing the firm is an eroding pricing landscape caused by persistent softness in the commercial property market. This softness is highly concentrated in large commercial accounts and excess and surplus lines, which could continue to place a hard ceiling on top-line revenue growth in the near term. Internally, the company faces execution risk. Relying on newly deployed algorithmic nodes to seamlessly absorb the workload of a 20. Chubb operates a fortress balance sheet, utilizing its severe underwriting discipline to safely fund a digital transformation. By prioritizing profit over market share, Chubb secures its position as a premium financial compounder for the next decade.